In a massive intensification of his trade war, Donald Trump on Wednesday announced large additional tariffs after the market closed. These tariff amounts caught the world by surprise as they turned out to be much higher than what they expected. Trump declared 10% tariffs on all imports into the US and even higher duties on items from roughly 60 nations or trading blocs that have a significant trade deficit with the US. This includes levied new duties of 34% and 20% imposed on China and the EU respectively. We haven't seen this much tariff activity in America since before World War II, and the tariffs announced by Trump have been causing a significant amount of panic in the stock market. After the event on Wednesday, Dow futures fell by 1,000 points, sparking fear that tariffs might bring on a trade war with the rest of the world. Even worse was the S&P 500, which was down 3.6% Wednesday evening after the announcement. But leading the sell-off Wednesday night was the Nasdaq Composite, which at one point was down 4.5%. This adds a lot of stress to the markets already, seeing how, as of April 2nd, all three major indexes were down for the year, with the Nasdaq falling the hardest. Here on Thursday, as the trading day comes to a close, things are shaping up to be much worse, as you can see. According to this article from the Daily Mail, after Trump gave his speech, trillions of dollars were wiped off of Americans' 401k plans. And that's just one type of retirement account, never mind IRAs and also non-retirement accounts, HSAs, college savings accounts, and all of those variations. So far, China, Japan, and South Korea have said that they'll respond to Trump's additional tariffs. Mexico announced that they'll take additional action to protect their automotive industry, and Canada said that they're going to fight these tariffs with countermeasures. Likely, most other countries are going to impose their own policies in order to retaliate for what Trump is doing. With all this going on, it's important that for dividend investors like us, we try to understand how these tariffs are going to impact our dividend-paying investments. Now, before getting started, it needs to be said that if you're a long-term focused dividend investor and it's your goal to someday live off distributions, then share price drops aren't the biggest concern. The dividend safety of your holdings should be what matter most. If you're holding a solid dividend-paying company and its share price collapses by 20%, it doesn't really matter if its share price takes months or even a year or longer to recover. Do not just start panic selling because the markets are falling, it's the dividends that matter. During this season, I'll likely repeat myself often here, but I need to remind you all that red markets are the best time to invest. If a solid holding in your portfolio was yielding 6% and it now yields 8% after a massive sell-off, you're now getting 33% more dividends for every dollar that you invest going forward. In terms of what exactly we can fully expect to come from these tariffs, there isn't a unanimous agreement among economists. We haven't seen tariffs like this in over 90 years, so in terms of how severe things are going to be with the economy, it is a bit of a mystery at this point. But we do know certain things based upon the nature of tariffs and how smaller trade wars have impacted other specific countries. When Joe Biden was in office, he also used tariffs against China, so we can also look to that. But in terms of specific dividend sectors, Trump's tariffs largely didn't impact the energy sector. According to this article from the Washington Examiner, imports of energy products like oil and gas were largely sparred from President Donald Trump's sweeping tariffs issued Wednesday afternoon. Trump, who declared Wednesday Liberation Day, announced that he would be imposing a baseline 10% tariff on all exports to the United States with minimal exceptions and higher tariffs on other nations that impose trade barriers on U.S. goods. Luckily for the industry, the White House confirmed in its executive order that energy and energy products were exempt from the reciprocal tariffs. So that's one dividend-rich sector that shouldn't be impacted as severely as others. In terms of real estate investment trusts, there are a lot of REIT sectors that exist, but likely the REITs that face the most risk would be the retail REITs. These companies own shopping centers, malls, and other retail spaces where goods are sold. If you're curious about a specific REIT, then you'll have to go to their website to determine how impacted the company you're looking at will be. For example, many retail REITs own properties that are occupied by service businesses. These won't be impacted by tariffs nearly as much since they aren't selling physical goods. To give one example, Triple N REIT, ticker NNN, is a popular retail REIT. But if you look at their property breakdown, you'll see a lot of them are fitness centers, movie theaters, car washes, and other property types that won't be largely impacted by these tariffs. Car retailers are expected to take a major hit from these tariffs, but most REITs own little to none of these types of properties. We're all likely wondering if it's possible that the economy could go so bad that it causes a large number of retail stores to close, resulting in high unoccupancy ratings for these REITs. And at this point, we just don't know that yet, but many REITs survived the 2008 financial crisis without experiencing a dividend cut, and that was the worst economic disaster since the Great Depression. With business development companies, I don't see this sector being as negatively impacted for a couple of reasons. Most BDCs like to target service-based companies, not retail companies. Their share prices will fall, potentially hard like the rest of the market, but I don't see any reason to believe there's going to be widespread dividend cuts, at least based upon the evidence that we have right now. Look at the sector breakdown for Ares Capital, the largest BDC. 25% of their portfolio is software services, which won't be largely impacted by tariffs. Healthcare and equipment services, again not largely impacted. Ivy Hill Asset Management, not really impacted, and then their senior direct lending program, again not so severely impacted, and so on. The same is true for Blue Owl Capital. Look at how many of their investments are service-based. BDCs like to hold service-based, non-cyclical companies. They could have trouble finding companies to lend to if economic growth comes to a crawl, but again, we just don't know at this point. One of the biggest concerns out there are for companies that are considered consumer discretionary. That would include individual automotive stocks, fashion, textiles, distributors, and other similar companies. Many of these kinds of stocks do pay dividends. According to the Associated Press, many retail companies may try to simply eat the tariffs if they aren't too severe. So in other words, absorbing the cost themselves and making sure their customers won't have to pay extra for their goods. But that's not very likely to happen for most, especially if they're much higher than Trump's 10%. That would negatively impact their free cash flow, which is the money companies have left over to do things like pay dividends or perform acquisitions. Each company will have to decide what they want to do. What also gives dividend investors the upper advantage in this kind of market is that dividend-paying stocks on average are more stable. Being able to pay a dividend is a sign of financial strength for a company. It shows they have a lot of free cash to reward their investors. Everyone else that's investing in these high-risk, highly speculative kind of companies is really going to suffer more in these kind of markets. But what we're seeing right now, as bad as it looks, isn't the end of the world. If you're watching this video right now, there's a 95% chance, according to my analytics, that you've made it through a much worse economy. If you're nervous about the safety of your dividend holdings, then I would give you the same advice that I've been giving this entire year. You can't go wrong with a solid dividend growth ETF. There are plenty of good ones that exist that have offered stable growth for many years. Whether your favorite is SCHD or one of Vanguard's dividend funds, DGRO from iShares, Fidelity's dividend ETF, FDVV, or even something else, they've all offered really good performance and dividend growth over time. I know they're not the most exciting holdings, but they've proven to be very dependable and one of the safest dividend holdings that you can buy for their diversification. So again, if you're a long-term dividend investor, don't get caught up in these share price movements. Look to your dividend distribution history instead. That'll make you feel much better because this is what should matter most of all to dividend investors. Let me know in the comments your thoughts and if you think we're really doomed or not. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.